Can emerging markets survive a U.S. economic crash? Introduction. The global economy has always revolved around the United States, the world's largest consumer market, reserve currency issuer, and financial center. When America sneezes, the rest of the world catches a cold. But what happens if the U.S. faces a serious economic crash? Can emerging markets survive such a shock, or would they crumble under the weight of global dependence on the dollar? A major U.S. downturn would immediately affect global trade, capital flows, and investor confidence. The American economy accounts for roughly 1/4 of global GDP, and its stock market is the single largest source of global wealth. If a crash occurs, whether due to rising debt, banking instability, or political gridlock, the first impact will be felt through financial markets. Investors would flee to safety, driving the U.S. dollar higher and pulling funds out of emerging economies like India, Brazil, Pakistan, Turkey, and South Africa. Most emerging markets rely heavily on the dollar for trade and debt repayment. When the dollar strengthens, their local currencies weaken, making imports more expensive and foreign debt harder to repay. Countries that depend on imported energy or food could face inflation spikes, while central banks might be forced to raise interest rates, slowing domestic growth. This dollar dominance means that a U.S. crisis often becomes a global liquidity crisis, even if the original problem was purely domestic. Not all emerging markets would suffer equally. Some countries have built strong buffers against global shocks. India has robust foreign exchange reserves and a diversified economy. Indonesia and Malaysia could benefit from commodity exports if prices rise due to supply disruptions. China has large reserves but faces challenges due to its real estate crisis and slowing demand. Countries with weak fiscal management, such as Argentina or Pakistan, would be hit hardest due to limited reserves and high external debt. In short, survival depends on how prepared each country is for a dollar storm. In recent years, many emerging economies, including members of BRICS, have started discussing ways to reduce their dependence on the US dollar. Trade in local currencies, gold reserves, and alternative payment systems are being explored as shields against American financial shocks. However, these changes are gradual and cannot fully replace the dollar anytime soon. Still, they mark a strategic evolution in global finance, signaling that emerging markets no longer want to be mere spectators when the U.S. falters. Can emerging markets truly decouple? Realistically, complete decoupling from the U.S. economy is not possible in the near term. The dollar still dominates global finance, and Wall Street remains the world's investment hub. Yet, emerging markets can strengthen regional trade, diversify reserves, and build stronger domestic industries to reduce vulnerability. Survival in a U.S. crash will depend not on isolation, but on resilience and adaptability. A U.S. economic crash would shake the foundations of global trade, but it would not necessarily destroy the emerging world. The nations that have learned from past crises, that invest in self-reliance, trade diversification, and sound fiscal policy, will not only survive, but may even emerge stronger. The message is clear. The future of global trade depends not just on America's stability, but on how wisely emerging markets prepare for the storm that may come from across the ocean.